if the US freezes the assets of even Afghanistan, what has Afghanistan done to the US? It's one of the poorest countries in the world. And the US freezes their assets. They freeze the assets of Russia. Then India and China and Indonesia and all these countries, they say to themselves, do we really want to hold all our assets in the United States? And they come to the conclusion, no, we want to have something safe. So they buy gold. And they can also see the money printing that is going on in the US. They can also see the debt grows and the interest payments grows of the US government. And so they don't trust the US dollar anymore.
According to a recent report from the Federal Reserve Bank of New York, Americans expressed heightened expectations for long-term inflation in September, coinciding with rising concerns over credit instability. While inflation is anticipated to remain stable at 3% over the next year, expectations for 3 years have risen from 2.5% to 2.7%, and for 5 years from 2.8% to 2.9%. Prominent Swiss investor and economic commentator Marc Faber underscores that central banks worldwide are easing monetary policy, indicating they have not tightened enough to trigger a recession or substantially reduce inflation. This continued inflationary pressure has prompted many investors to acknowledge the looming economic challenges. In line with this, the European Central Bank recently cut its key interest rate to 3.25%, marking its third quarter percentage point reduction this year. Market participants had already anticipated this move after the ECB highlighted diminished inflation risks and a slowing growth outlook. Meanwhile, Goldman Sachs forecasts that the U.S. Federal Reserve will implement consecutive 25 basis point interest rate cuts from November 2024 through June 2025, bringing the terminal rate range down to 3.25% to 3.5%. Faber notes that wealthier individuals increasingly seek safer assets, recognizing the potential for economic instability at any moment. Although no investment is entirely without risk, gold has emerged as a relative haven. While governments can more easily seize real estate or impose higher taxes, taking gold is more technically challenging. Throughout 2024, gold has solidified its status as a premier asset, consistently reaching all-time highs since December of the previous year. Currently approaching $2,700, it threatens to surpass the existing record of $2,696 set earlier in October, affirming its position as a superior investment for many. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
It's very clear that the central banks around the world are again easing. In other words, they haven't tightened all that much because had the money become very tight, we'd be in a recession and we would have a very low inflation or negative rates of price increases. But this is not the case. Inflationary pressures are still there. And I think that investors are realizing there are huge problems in the sense that, say, we have in America two presidential candidates. One is plainly dumb, and the other one is also, like the first one, a big spender. They have no intention to cut the deficits at all, to cut the debt at all. They both will add with different programs to the credit growth of government in the United States. And the US is not alone. Other countries do the same. And so we will move one day into some sort of a financial crisis. Whether it happens tomorrow or in 3 years, who knows? Because you can postpone with printing money for a long time. But I think more and more, especially wealthy people, realize they want to have something of their assets in an asset that is relatively safe. I'm not saying it's 100% safe, because if governments could lock you in under the pretext of COVID, they can also take your assets away. And the first one to take away would be, say, real estate, because that's obvious to anyone. And it can be done in a very elegant way, in the sense that you just increase taxation on real estate until most people can't afford to live in their own homes anymore. So I think that gold is kind of a safe haven. but it's technically maybe more difficult. And as you know, different countries have different property rights. Say in Switzerland and in Singapore, property rights are very strong. So to take
Right.
it away from you in these countries would be quite something. Also in Thailand, I have to assume that, say, the king has some gold, so he's not very likely to want to take it from other people. All I'm saying is some countries are more likely to protect the ownership of assets of its individuals, and other countries are less likely to do it. And say in the United States, Mr. Trump is more likely to protect property rights than the communist that might be elected.
According to the Treasury Department's report on Friday, the U.S. budget deficit has surged to $1.833 trillion for fiscal year 2024, marking the highest level outside of the COVID-19 pandemic era. Notably, interest payments on federal debt have surpassed $1 trillion for the first time, with increased expenditures directed toward the Social Security Retirement Program, healthcare, and military spending. This year's deficit reflects an 8% increase, or $138 billion, from the $1.695 trillion recorded in fiscal 2023, making it the third largest federal deficit in U.S. history. Only the pandemic-driven deficits of $3.132 trillion in fiscal 2020 and $2.772 trillion in fiscal 2021 exceed it. The fiscal 2024 budget gap accounts for 6.4% of the gross domestic product, up from 6.2% in the previous year. This significant deficit could complicate Vice President Kamala Harris's argument in the lead-up to the November 5th presidential election that she would be a more responsible fiscal steward than her Republican opponent, Donald Trump. Marc Faber highlights the implications of rising government debt, noting that interest payments increasingly consume a growing share of tax revenue. This trend restricts funding for essential services such as social programs and infrastructure improvements, ultimately stifling economic growth. Moreover, as the government is pressured to print money to meet its interest obligations, it risks entering a detrimental cycle of rising inflation and interest rates, further exacerbating the overall debt situation.
I'd like to say this. I mean, the economists today, they are paid by Wall Street, and Wall Street is in essentially in alliance with the Federal Reserve and so forth. I don't think they want to present the truth. The fact is simply there's a point at which the government debt requires increasing interest payments. In that sense, one wheel has come off because over the last 18 months, the interest payments on the government debt have more than doubled. They're now at over $1 trillion a year. And it doesn't look as if interest rates will drop a lot unless we are in a recession. But at the present time, since the rate cuts occurred, the US Treasury market, long-term bonds, have been actually selling off. They haven't been rallying. So the bond market doesn't like these rate cuts because the bond market knows that these rate cuts are inflationary. And the old economists, the classical economists, including, by the way, an American economist, Irving Fisher, he wrote about the debt deflation theory. The problem is, as government debts become bigger and bigger, an increasing portion of the tax revenues, in other words, you and I, we pay tax. The government gets these tax monies that we pay. These are the government's receipts, and they have to pay the interest on the debt first. So the interest payments on the debt actually retard other programs of the government that might be, say, more desirable, say, helping the poor in America,
Right.
or doing something about the infrastructure, which is not particularly good in the United States. So over time, the debt payments become burdensome and hinder or make economic growth totally impossible. So then there comes the day when the government is actually forced to print money to pay the interest on the debt. And that is, in the process of accelerating inflation, a pillar that will make it clear and sure that the inflationary pressures actually accelerate. And when the inflationary pressures accelerate, the interest will go up and the debt payments will increase even more.
Dr. Faber, are you talking Ben Bernanke helicopter Ben Bernanke printing levels here?
Yes, I mean, my sense is, if I look, actually, I'm just writing about this, about the 1970s and the 1982 crisis. And now I'm addressing the crisis of 1929. My sense is that the US is, and other Western European countries, they are so far along in the process of fiscal deficits that there is no way out but to print money. There are ways out, but as a politician, if you go to your citizenship, then you tell them, look, we have to tighten our belts. What it means is you have to pay higher taxes, and you, the policeman and the fireman and everybody, you get lower pension.
The current economic landscape presents significant challenges, particularly with the soaring budget deficit and rising inflation expectations. As the government grapples with increasing debt and the pressure to meet interest obligations, the potential for a cycle of inflation and interest rate hikes looms. Given these developments, how do you foresee the impact on investment strategies and asset allocation in the coming months? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.